Hi there. Today's content, I want to dive deep into a bunch of things that are concerning me about industry super funds. So I'm going to go through 7 high-level things that are concerning me about industry super funds. And I want to start by saying um, they're not the devil. They've actually done an amazing job in the past. If we go back to the 80s, when superannuation was made compulsory by Paul Keating, industry super funds were created by the ACTU. Gary Weaven led the charge, and they were a great thing. They provided well-managed superannuation for the masses, particularly unionised workers, and they actually bought the big end of town. Think of all the banks and big insurance companies that used to dominate, that sort of stuff. They brought them to account, and that changed the future. And I'll cover off on bits of that as we go through this story. But I'm worried now because so many people are invested in industry super funds and they've become so big that if they were to fail or even underperform for the next decade or more, it's going to create challenges for many people. So the punchline of this, and I'll come to the end, is review your super very carefully. Think about the strategies that you have. So let me start off with my concerns. I'm going to go through 7 concerns. The first concern, they've gotten really big. Now, big isn't always bad, but in the world of investing, it's very rare that big companies outperform smaller managers. As companies get bigger, they get complacent, they have more people, they have more process. There's loads of, if you go to the AFR and Google industry super fund and challenges, there's loads of stories. I've been following these stories for about the last 5 years, and I'm going to dive into bits and pieces of them. But on the big side, that's led them to become arrogant. So, and this has increased since the Royal Commission. So the Royal Commission of the banks, which included the banks' fund management areas, uncovered massive problems of what I would call the big end of town. So the big end of town, the big banks, the insurance companies. I'm going to avoid naming specific names here. I don't want to be sued. I don't want to be pursued by people that are much bigger than me. So I'm going to talk generally, and once again suggest you do some pretty serious due diligence and watch some of our other stuff to work out how you can potentially take control of your super. But the challenge with the Royal Commission, all the banks got out of funds management pretty much. You've had the fallover of AMP. So all of a sudden, the big banks and insurance companies are no longer in funds management. And that's left this massive void that the industry super funds have stepped in. And all of a sudden, they're the big gorillas in the room. They're the ones that are managing the most money. And they've done that in a fairly good pattern, but they're starting to see some patterns of concern. So what happens when people get big too is they develop what we'd call hubris. So that is that they're too good. They don't have the competition to keep them down. And that hubris is that fluff that means they don't necessarily take seriously the things that made them good in their early days. And that brings me to number 2. This is a pretty boring topic, but number 2 is their governance. The governance of the industry super funds is under a lot of scrutiny by APRA. Governance means their directors, their investment committees, etc. Most investment committees in the superannuation space have independent directors or trustees, and that enables the normally the shareholders, but in this case the superannuation members, to know that there's outside experts asking the hard questions, and it's not just all insiders. So what you have on the industry super fund boards is a lot of insiders, and I'm going to talk here about union officials and union connections. If you want to look at some of this, have a look at CBuzz and in the AFR, many articles on their governance. Their chair is a former Labor politician, Swan. Their whole board is CFMEU members and Masters Builder Association members, predominantly not 2 groups that have a whole bunch of experience in investments. Now, they've had some good returns. If you look on their thing, they're very much focusing on returns of 10, 20, 30 years. Now, that's partly because their returns in the last few years have not been up to scratch. They've been below average. So they then will point and say, but we've got really good long-term returns. Now, that was awesome, but it's if this is a change in actual trend rather than just a bad year or two, it's a problem. It's a problem for those who are going into the funds now. And I'm going to talk more about some other problems related to that. But across the board, this is the case. A lot of these big industry super funds have lots of members on their boards and investment committees who represent the unions in theory. Now, this creates a conflict that most people aren't aware of. And keep in mind, there's been so much in the last 5 years post-Royal Commission about avoiding conflicts of interest. But yeah, listen to this one. Industry super funds, some of the trustees within those super funds who are representatives of particular unions that feed into those funds, they don't actually get paid. Now, if you look at the accounts of the big industry super funds, they are paying money out for it, but it doesn't go to the individual, it goes to the unions. So all of these directors' fees, board member fees are creating a massive pool of revenue for the unions, which in turn donates a large part of that to the Labor Party. So there's a massive conflict of interest. Not saying that's always been bad. In the early days, that protection of the workers, that trying to keep them away from some of the past sins of the big end of town, High Commission, stuff like that was brilliant, and they were awesome at getting that under control. But that tide turned, about 5 years post Royal Commission, big end of town gone, no commissions anymore, massive transparency for the super funds, the fund managers, financial advisors, etc., except for industry super funds. So yeah, way less transparency. I'll touch on that as one of these big issues as well. So this governance means we've now got these big monsters that manage, literally trillions of dollars in Australia on behalf of very regular workers. And you've seen the ads, how they position industry super funds. That compare the pair, all these ads, that they're somehow this superior beast. And they're spending lots of money on those ads. None of that's accountable as well. So, and yeah, it's a worry. Now, each of these worries I'm going through on their own wouldn't necessarily be a big thing, but when you put them together, it's a little bit of a concern. So let me go to number 3. And I'm going to talk about private assets. And for some people, this will be a bit confusing, but let me explain in a simple way. You've got private assets and public assets. Private assets and listed assets is a better way to think about it. So on the ASX, we have listed companies, BHP, etc., etc. But industry super funds, amongst others, they're not the only ones, but they also invest in unlisted assets. So unlisted assets are assets where there is no listing. So it's very hard to tell what they're worth. They're only worth what the valuers say they're worth, and the valuers only value them so often. So let me give you an example to understand the story. In Australia, we've got two of our biggest airports, Sydney Airport and Melbourne Airport. Sydney Airport was listed, and during the pandemic, Sydney Airport shares went down 70 or 80%. Now, the industry super funds hold a stake in Melbourne Airport. It was impossible to tell what they downgraded that to, but they absolutely did not downgrade it by 70 to 80%. So when you're comparing the pair now, here's what happened. The listed stake fell massively. So it comes right down. But here they pretend it's still above. Not sure where, because they won't tell us exactly how they've valued it. You can't find the valuations. But let's say they did it here. Now, what happens in the next few years? As Sydney Airport rises back, as happens, they can't push up Melbourne Airport. So they're going to underperform on that comparison. And we're seeing this. In the last 3 years, the industry super funds have underperformed. And it's partly because they didn't downgrade their private assets at the same rate that the listed market did. Now, some people say that's a good thing. It smooths out returns, and it might mean investors don't panic and sell. And part of me agrees with that. But I've got a problem because there's new members coming in this fund. And and this is what happened in 2022. ASX listed property funds went down about 20-ish%. Don't quote me on the exact numbers. The principles here are what's important. Now, so down about 20% for listed or public assets. Private assets in the same space in Australian property by the industry super funds showed a 7% positive return. Now, the properties are not that different. If you look at the long term, they perform exactly the same. So over 20, 30 years, the performance between the listed and the unlisted are almost identical. But all of a sudden, massive difference, 30%. So, yeah, and these for buildings next door to each other. Sometimes the same buildings, just held through different structures. Some held publicly through listed, real estate trusts, and some held privately through private assets. So what's this has meant in the years subsequent to the pandemic, and we're now pushing up to 5 years. And this was post-pandemic. Property prices struggled with people working from home. There was an unknown factor in the market, what was going to happen. So commercial property dropped a lot. Now, if you were in a super fund that was listed, that had listed access to that, you copped it and then you recovered well. Now, if you're in a industry super fund that had exposure to that through private assets, which is most industry super funds. So most industry super funds do have a decent chunk of private assets investing in direct property. And that can be a good thing. My issue here is with the pricing, not with the assets. The assets are fine, held for the long term, they're going to do well. But let's say you had someone who retired in, I'm going to call it January 2023, and they go into an industry super fund that did not drop the value of their private assets. Now, whether that's property, infrastructure, tech, private equity, there's a lot of them that they did not drop. Now, it should have dropped by a certain amount. Whether that was 10%, 20%, 30%, it's very hard to tell because they don't disclose comparative valuations. So fresh money came in January 23. It was paying over the price. So it's okay for new investors, all the smoothing, but for investors that were coming in fresh in 2023 into these funds, they were paying potentially 10, 20, 30% more than those assets were actually worth if they were valued in the same way as public assets, listed assets. So that means those people have underperformed for the next 3 years. Now, if I was those people, I'd be really, really angry because they followed in based on all those ads of compare the pair, higher returns, etc., and they've then overpaid somewhere between 10 and 30% for a whole bunch of assets within those funds, which has led to their underperformance. Will it come back? Yes, but that comeback only helps the people that were already there, not the people that have gone in at the bottom of those cycles. So if you went into an industry super fund somewhere in the year or two after the pandemic, after COVID, you probably paid too much for the assets. And it's something that they haven't been held accountable for. So now those private assets, there's a backstory here. So back in the 70s and 80s, there was two endowment funds in the US, Yale and Harvard, that managed a lot of money. And endowment funds are where people leave money to their unis and it gets invested because it's needed for the long term. So it's very long term. There's no money likely to be pulled out without notice. So those two funds pioneered the use of unlisted assets and massively correlated. So they invested in infrastructure, property, direct property, all sorts of other direct assets, hedge funds that were different from just shares and bonds. Yeah, that had traditionally been the path there. And they actually performed really well. They outperformed most assets. So then we saw in the 80s and 90s super funds, particularly industry super funds, public super funds. When I say public super funds, government type super funds started to follow the same path. And it's a good thing. I don't have a problem. In fact, I like it when you've got that massive diversification that comes from investing in these other asset classes. The issue that I've got is with the transparency of the valuations and the pricing and the problems that leads to. So we've got these industry super funds becoming bigger and bigger. At the same time, they're slowly increasing their assets from in the unlisted space, in the private space, that started off about 10% and is now approaching 25%, somewhere 20 to 25% in most of the big Australian funds. So we've got a double whammy going in here. We've actually got a triple whammy. We've got the funds growing, we've got their exposure to unlisted assets growing, and we've got a challenge is that this is happening all around the world. There are many articles out there, many investment professionals worried about the private market because of this lack of accountability. So we're at a stage where private investments has gone up tenfold across the last 10 years. So this is things like you may have heard about private credit, private equity, infrastructure investing, direct property investing through private vehicles that don't have an easy way of doing market pricing. So market pricing is where there's a listed market that votes on the price every day. The share market tells the story. So it's a complex thing, but it's an issue when when you can't see what you actually own. I'll give you an example around private credit, and private credit is a massive concern to me and many of my colleagues that have seen things like this happen before, particularly in the 80s in Australia. So private credit is where a bunch of investors give money to a private credit manager, and they make loans to mainly companies. These companies could be startup companies, they could be established companies, they could be any type of company. And that's not a bad thing. But the thing is, there's very little disclosure because of the nature of these funds. They don't have the same regulation that the banks have or other lenders have that are licensed through APRA and the other regulators. So they don't have to disclose things like bad debts. So you don't know. This is what I call Titanic risk. You don't know whether these assets are going bad until something big hits. And there's been lots of little things starting to happen lately where some of these things are going under. There's also a lack of transparency about how up to date all the loan repayments are for the investors in some of these things. So, and if you think about it, wherever lots of money goes, you get these booms, then potentially bubbles, and post that is a potential crash. The hot area of the last 3 to 5 years is private investments. So whether that's property, infrastructure, private credit, or private equity, it's just been such a hot area. And the money going in is expanded. And the worry about this is it's now starting to, these assets were once used by professionals. These private endowment funds, they were used by institutions, by big family offices that had the ability to analyze what was under the bonnet, get regular reporting so they knew what they were investing in. But all of a sudden, all these assets are being marketed to retail investors. And this is normally the last stage of a bubble where assets get moved and all of a sudden they're being pushed to retail investors because all these other professionals do it, and especially in a low interest rate environment. So all of a sudden, private credit funds are saying 7, 8, 9, 10, up to 12% returns. Now, I go simply, if you're being promised returns of that level, these guys are lending money to people that can't get bank finance at 6, 7, 8, 9%. So that's got to introduce a level of risk all on its own. And some companies are happy to take this on and pay a little bit of extra for certain reasons, but it's just exploding. So that's that triple whammy. You've got massive industry super funds just growing. The industry super funds are growing massively. Within that, their allocation to private assets is growing. And then you've got the whole market of the private assets now exploding and going into retail investments. If there's a collapse or some sort of meltdown in these assets, all of a sudden, who pays the bill? It's all the retail investors that have gone in, whether it's through their industry super funds or whether it's as retail investors. There's also an explosion in private wealth. I'm not going to spend time on that, or we won't cover enough here. So that was number 3. Number 4 is they're all employing more people. They're becoming more active. So in my experience, and that's 40 years in investment markets, as companies get bigger, they don't get better. And this applies for their investing process as well. So, some of the big industry super funds are hiring 40, 50, 100 new investment analysts to look for ways to, get good returns. I found that rarely does that actually lead to getting good returns. Some of the people that have beat the market over the years tend to be quite geniuses. For most people, you get a much better return by using index based investing than active investing. So that was number four. Um, Number five, I've talked about in the others, but it's the fact that their performance is slipping. Their 1, 2, and 3 year performances are under index performance and under some of the old school performers, ironically. But they just keep pointing to their good long term return as if this is a break in their pattern that will soon be returned rather than a fundamental shift. Now, it might be. Maybe they come back, maybe everything stays calm, but if there's any sort of meltdown in the private asset world, then this will be a big, massive problem for the industry super funds and the retail investors. Number six, they just lack transparency. I rang one of the funds the other day. I was online trying to evaluate their fund. It's a big fund. It's one of the top four in Australia. And on their website, you can find their strategic asset allocation. So their strategic asset allocation is, it'll say Australian shares, 35%, international shares, 40%, stuff like that. But in there, when I dove into their PDS, it also has a range that they can go to. This is called their tactical range. So in this case, the Australian shares at 35% had a range of 10 to 50. I thought, wow, that's a big range. I wonder what it is right now. So I play around the website. I can't find it. I ring up their well-meaning team in their call center, and they say, "Oh no, that's the 35% is the asset allocation to Australian shares right now." And I said, "Well, hang on. It says in your notes you can range between 10 and 50%." And eventually she went away, got a supervisor, and they came back and said, "Yes, it does vary." And I said, "Can you point me to the website?" They said, "No, we don't publish it." I said, "Oh, that's interesting. Why not?" "We're not required to by law." And then I said, "Can you send it to me?" And to their credit, they sent it to me. I asked if I could tell what the breakdown between their listed and unlisted assets was, and they would not provide that to me as well. So all these things are lack of transparency. It makes it very hard for me as an advisor to recommend them because I don't know what they're invested in. Yeah, at the simple level, if I invest in an index fund, I know exactly what it's invested in. And if I look up the funds that we prefer to use, I know their targeted asset allocation. I can find out their asset allocation right now. I can look at any changes they've made. And generally, there'll be a commentary about why they've done it. You don't get any of that with most of the industry super funds. Very hard to tell what they're invested in. They talk at high level. They become secretive. All that stuff is dangerous. And then sometimes they'll even verge on the complete opposite. Instead of saying, "All right, let's be transparent," they say, "Yep, we'll tell you what we're invested in." We downloaded from one of the big industry super fund sites their current portfolio. It's got 10,000 items in it and almost impossible to tell the nature of them. Yes, they're grouped together, but for an average punter with their super, very hard to tell what their current strategy is. And they're not very forthcoming. Once a year, you'll get some broad general notes in their annual reports, but very hard to tell what they're actually doing. And at the moment, they're hiding behind their low performance by saying that, you know, listed assets outperformed, unlisted assets. So that's why they're a little bit behind, and that will catch up and even up. Maybe it will, but not if this bubble is emerging. And my last reason, it's not my last one, by the way, but it's the seven big ones. Um, they hide the bodies of the failed industry super funds. So when you see the compare the pair ads, they make it out that these all industry super funds are somehow superior to other super funds. That's what they're implying. The reality is there's been plenty of industry super fund failures over the last decade. There's been plenty of industry super funds underperforming over the last decade. And what they're doing is as soon as they start to underperform for any period of time, they will merge them in with another successful industry super fund. And hopefully that's a good thing for all the superannuation members that are being moved, but it means they're hiding the body. So all of a sudden, the results of those old funds are clouding the averages. And I'll give you a public example. Q Super, which is the industry super fund that lots of state government employees in Queensland invest in, was once a great performing fund. in its last 5 years, its performance was pretty abysmal on any way you would compare it, and still is for some of the people that are still in the life cycle funds there. QSuper was quietly merged with Sun Super, which has had a tremendous history, although it also has all the issues that I've talked about, but it had a solid history. So all of a sudden, QSuper will no longer be seen to be showing how it's underperformance. So if you take away, this is called survivorship bias in analysis. So if you're only analysing the current people in the market, you don't get the performance of all those that failed. So survivorship bias means the average of industry super fund returns look higher than they should be because all these failed funds have been hidden. That's what I call burying the bodies. Pretty serious topic, but as you've seen from a lot of the stuff that we're talking about, a difference of 1 to 2% over a lifetime is millions of dollars for good income earners in Australia. So yeah, I had to put together this content for you to get thinking about your super and to dive deep, to scratch the surface, to be careful who you're dealing with. Make sure you're dealing with people that will tell you what's going on, what's and all, not people with vested interests in existing products or future products. Until next time, Rob McGregor signing off.